Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on February 27th, last week of February. Miles, I'm Ian Saunders, on here about Miles Clark. Hard to believe we've torn through the first couple months of the year.
I know it's like you go from New Year's and then you got Valentine's Day and then now we're in kind of that lull of no fun holidays. But it certainly has been an eventful start to the
Hey, I don't know what you mean. No fun holidays. We just had Mardi Gras.
well, that is
That's a pretty
true.
good time. We got St. Patrick's Day coming up in a couple
All
weeks.
right, but yeah, I'm proved
So
wrong.
maybe I'll have more fun of those holidays than you. Who knows?
Maybe.
But there has been, it felt a little bit of a lull. Things are to seem kind of normal. I feel like this is a time of the year, at least from a work perspective, all the gears are churning,
Yep.
things are going, and markets are definitely seeing a little bit of churn too, right? We've seen a lot of individual stocks have shown a lot of downside, and
Right.
I think that that's been a frequent theme that we've covered in our report. But we've seen some interesting action over the past week. You had some performance stuff that you were looking at, just the kind of surprising performance.
Yeah, so in terms of the last 1 week roll, the top three names, gold, precious metals continuing to chug higher, emerging markets, which we'll talk about a little bit later, EEM up around 3.5%, the Nasdaq Composite rebounding almost 2%. So some of the growth focused areas getting a nice little a bit higher after their most recent exhale.
Well, I think that that's an important thing to know because when we look at, hey, markets, the Nasdaq composites had a rough start to the
Right,
year, but it had a good week.
right.
But it was still other areas where other asset classes still outperformed it, right?
Right.
Which I think is an important thing to know.
Yes, and to further that conversation, when the names we typically look at, right, some of the major market areas, the Nasdaq Composite's still one of the only names that's actually negative for the year.
Mm.
The US dollar's down there. S&P 500 up around 1.5%. What do you think is the top performing asset, just kind of from a broad perspective?
Silver.
Oh, well, that's not in the list, but it probably is. Gold is up 20 and a half, 20 and a
Okay.
half, which I mean, with all the volatility we've seen in the precious metal space, if I wasn't watching it, I wouldn't say that gold was up 20% this year again. But hey, here we are, right? Emerging markets up.
Silver's up 29, so I was right
Yeah,
there.
you are right. There you go. You got me beat. Emerging markets up there as well.
Yeah, yeah.
Developed markets, crude is also catching a nice. So there's a lot of other areas outside the domestic space that are doing quite well, as I think is the point. And domestics aren't doing too bad either, but you're seeing other strength emerge elsewhere, right?
Yeah, yeah,
Yeah.
absolutely. But domestic equity's not doing too bad. They've done pretty darn well for the past couple of years,
Yes.
right? And so
Zooming out.
that's yeah, exactly. I mean, that kind of consistency can't continue forever. Um, I think that it's inevitable to see some turbulence. How long that turbulence lasts, how long that difficulty lasts, if it persists for years, we see domestic equities improve, but not improve as much of other assets. Wouldn't be surprised there. If we see some kind of culmination downward move and then a snapback higher from there. Also wouldn't be surprised there, right?
Right.
I think there's a lot of different ways things could go. That's why we have the charts to keep us abreast with what's going on. But Trevor Poleska, one of our analysts here in the office, put together a really good piece, was it a couple days ago
Oh,
on
there we go. Yep.
Monday, I believe it was. Um, just contextualizing drawdowns in the S&P 500 over time. We are barely off all-time highs at this
Yep.
point. Like you said, S&P still up on the year. It feels a lot worse because a lot of individual stocks have done a lot worse,
Right.
especially names in the software space. They've been really, really beaten up. And when you came into, or I guess maybe a year ago or even 2 years ago, when the Mag 7 names were created, the feeling was, oh, if those ever dive, the market's going with it. That
Right.
has not been the case at all with what we've seen. But the fear's still there. What if everything else catches up? What if it falls, right? I think that's what the fear in a lot of people's minds.
Yeah, no, it's a really good point because the one performance metric I didn't say was the S&P is up 1.5%. The average S&P 500 stock up around 6. So you're
Mm,
seeing a lot of strength from some of the other areas, and we've got a sector dispersion graph later that we'll talk about that goes into that in a bit more detail. But for context, before we get off topic of Trevor's wonderful piece, it certainly feels like things are probably a little bit worse than they are in the performance perspective. I mean, we're getting calls in from clients saying, "Hey, is this the top? Is AI over?" Right? I mean, are the evaluations getting too heavy for these guys? Point is that there's some questions about downside and what could be in store. Now, there's a bunch of interesting graphs in here. We'll throw up a couple on the screen, uh, talking about the that very first or was that second graph there that goes through the historical range of downside by holding period. So
Mm,
this essentially, to put it in context, we'll look at the overall historical probability of an S&P 500 drawdown by holding period. This goes back to 1950. It's that bottom
yeah.
graphian. What I think is interesting, right? It's essentially saying, what are the chances that over this time frame I'm going to get a pullback of at least this percent?
Mm.
And so you'll see a lot of 100% in there. Where I think the interesting part is that that 15% drawdown there. In every 10-year time frame, you've gotten one. Of course, we're not at a 15% pullback right now. I'm not
Yeah.
saying that, but just to put it in context, right? At 15%, the alarm bells are sounding.
And we've already
Yeah,
gotten that. I mean, we got that last year with the
right.
tariff tantrum, right? I mean,
Yeah.
the other points, you're looking at 10% in every year period, 56% of the time. And we typically see one of those every 18 months. I think that kind of supports that. When you're looking at a 5% drawdown, which we haven't even gotten, you see those in over half of every 3 month periods.
Right.
So, I mean, I wouldn't say that that's on immediately on the horizon.
Right.
Definitely not the end of the world if it happens.
Right.
We're a little
Yes.
bit overdue,
Not,
right?
yes, not abnormal. Pullbacks are normal. And then the next part that I really like about this specific piece is putting in context how far a drawdown would set us back. So now the next one that we'll throw up on screen is, from current levels, what would an X% drawdown look like? What level for the S&P 500 would it take us to? And ultimately, how many quote months are we giving up, right? What type of retreat does that look like? You're looking at, you've got to get to a 25% pullback to give back just the gains that we've seen in the last year, right? So to, again, put
In the
that,
last 10 months, not even a
yeah,
year.
exactly.
That's
Yeah,
crazy.
yes. So that just really when you zoom out and look at how strong it's been of the last not only year, but 2, 3 years for domestic equities in general, these pullbacks, they occur, but they're not necessarily something that, it's massively worrying because of how strong markets have been.
Right, exactly. I mean, no one wants to lose 10 months of gains.
Right.
But
Yeah.
if you could go down 25% and be like, you know what, that's only 10 months. I mean,
Yeah.
it feels like it should be a lot worse. And that's 25% of someone's portfolio potentially, right? And that's all been gained in the last 10 months. I mean, it's just a different way to look at trailing performance
Yeah.
in a different kind of light. But I think it does help kind of put in perspective, hey, pullbacks, drawdowns are inevitable, like the piece says. The inevitability of downside was the name of the piece. It's going to happen.
Yep.
They're going to happen in varying magnitudes over time. And almost you kind of want it to happen to allow the markets to continue to storm higher. I would
Right.
be more concerned if we were up 15% to start the year right now, because you would kind of assume, well, that's going to snap
Right.
back.
That's our full year, right?
Exactly, right?
Yeah.
But when we're looking at how we've seen movement play out over the course of this year so far, there's a couple pieces I think are interesting to take a look at. We put a piece in the report on Tuesday that looks at the percentage of one or the annual percent of 1% daily moves in the S&P over time. We've been doing this piece for years, um, almost a decade plus at this point that we've seen these updates. We try to do it quarterly. This one runs through the 23rd, so we've only seen 6 trading days at that point that showed a gain or a loss of 1% in value.
I would have told you we've had like 40.
Right. If you look at individual stocks,
Yeah.
absolutely. If you
Yeah.
even if you look at, hey, I almost updated this with the software space. That would have
Right.
been a more
Yeah.
interesting
Yeah. Yeah.
piece,
Yeah.
right? But only 6 trading days. To your point, I think you said earlier, it's felt a lot worse,
Yeah.
right? And the reason for that is 4 of those 6 have been 1% days to the downside,
Right.
which is very, very abnormal. If you look now, it's not a ton of days. We usually, on average, that's about 17% of the trading days we've seen this year. We're below the average. The average is around 26%. So we're below the average at this point if it continued. But even with 6 days, so the 33% spread in favoring the negative, the downside days. So you see twice as many downside days as you have positive days.
Right.
If that continued through the end of the year, that would be the largest spread favoring the negative that we've ever seen. So going back to 1987.
Right.
So what is that? That could tell you one of two things. It could tell you, hey, we're in for a lot worse year,
Right.
or like the worst year ever,
Right.
or we're going to get a snapback to the upside. The
Right.
thing
There's
that
going to be some mean
happens,
reversion.
yeah,
Yeah.
a lot of times big down days are followed by big up days. That hasn't been the case this year. We've seen big down days followed by smaller up days.
Yeah.
Down, smaller up, down, smaller up, right? Just hasn't exceeded that 1% mark. And we haven't got any major downside days, like we said, because we're not even off 5% from the market. So, but I think it does help put it in a little bit of a helpful perspective over time.
Oh yeah, for sure. I mean, that's one of my favorite pieces that we'll put together from time to time. The other one that you're not talking about that specific graph, but on the very bottom of that report piece, the count of those by month.
Yeah.
So it picks up a little bit. I guess the first meaningful pickup in terms of overall averages going from was 5.4 to 6.4 maybe. But you start to see a little bit of a pickup in March there as well.
March is the second highest month on average behind October.
Oh yeah, I guess you could put it
Yeah, I
that way
mean, so
too.
when you're looking at it, like January, February, relatively muted compared
Yep.
to the others. March is this sees the second highest count. And then now, obviously, these are averages, but we rarely see the averages actually play out. Usually, they're much higher, sometimes a few lower. We're not talking about a ton of days of difference, like you said, between 5.5 and 6.5, which
That's
is
also
March to
COVID,
October.
and it's also COVID there. I mean, October, you see the big standouts for like
A lot of
week and
stuff
eight.
happens though in March historically. I mean, we've seen COVID occur, the tariff tantrum stuff last
Oh,
year
that's
happened at the
fair.
same
Yeah.
time. The snapback rally in March of 2009 happened in the same time, right?
Yeah.
It does happen not every year, but there's a reason that we see more extreme days. Now, those could be extreme days to the upside. I think that's an important point to note.
Yeah. Yeah.
We haven't seen a ton of, if we do get a few days lower, the important point to watch out there is if we get sharp drawdowns. We haven't gotten, I think we've got 2% down day. If we start to get more of those and they're not followed by snapback days higher, even if those days exceed 1% higher, I think that's a good thing. If we get down and then maybe up 0.5% down, maybe like that's more of a concerning churn lower.
Yeah. The math starts to get stacked against you. Let's put it that
A
way for
little
what you
bit,
yeah.
yeah, but you would expect some more snapback updates to come into play at some point.
For sure. Talking a little bit more about, overall extreme movement, what we have seen is an extreme dispersion between sectors. So the next graph that we're throwing up, it essentially measures the dispersion between your best performing sector fund, and these are the spider sector funds, so the 11 that we're all familiar with, but your 11 sector funds and the max performing or the best performing sector through February 25th and the worst performing sector through that same time frame. So point is here, we kind of looked at that since 1999. 2026 brought a 30% dispersion or has brought a 30% dispersion between XLE, which is our best performing fund, and XLF, which is currently our worst performing fund, off around 6 or 7% or so. Point is that 30% dispersion is actually the third highest to open a year that we've seen in our data set. The other two instances, 2021 and 2022, interestingly enough, also
Very
led
different
higher.
years.
Exactly. Well, and that's what makes this kind of hard to predict off of.
Well, not also XLE, is that what you said?
Well, yeah, I was about to say that
Yeah.
XLE led us, has led us in all three of these higher years. But like you just said, Ian, very different years, right? If you try to predict off of 2021 and 2022, you're going to get pretty different results. So, I think if we're trying to be optimistic, we have a 50-50 chance.
Yeah, I mean, well, the
Right?
other thing I noticed on here, there's a lot of XLE. I
Yeah.
mean, you got XLE in what is that, 2003, 2004, 2005. You got XLE in 2011, XLE in 21, 22, and XLE. Think there's a lot
Yeah.
of crude oil, or I guess maybe energy stocks
Yeah.
more broadly.
It's
Who knows?
colder,
Yeah,
yeah.
starting out the year pretty strong in a lot of these months. That's kind of interesting. I would have expected a lot more XLC, a lot more XLK. There's definitely some XLK sprinkled in there, but there's a lot of defensive stocks that do pretty well to kick off the year in a lot
Well,
of these areas.
Well, and let's think about that, right? Like, not only just from a performance perspective, like, what is energy good or bad, but, no money manager is wanting to, screw the whole year up in the first quarter, right? And so there might be, I don't know, this might be anecdotal for me, but there might be some type of, just flow of, hey, let's play it safe here. Let's not take too many bets. Let's not go for XLC. Let's not go for XLK unless we really have high conviction there. I don't know, that might be anecdotal, but point is that, this sector dispersion is ultimately another good thing for us trend followers, right?
Right.
The wider the dispersion between our top ranked asset and our bottom ranked asset, the more likely momentum is going to be able to grab onto what's working and avoid what's losing, right?
Yeah, and I think it's also that we don't have this in the visual, but and not saying it should have been put in there, but I think it's interesting to say that hey, what's the best performer for the first 2 months of a year does not always translate over into what's the highest relative strength areas. We've seen, or on the contrary, what's the worst performer throughout the first couple months of the year does not always translate over into what's the worst relative strength areas. Right now, we still have. Energy's definitely improved in our relative strength rankings. It's not at the top of our rankings. Financials is definitely shown some weakness, but it's not at the bottom of the rankings, right? We're starting to see some rotation though. We just had one of our more popular strategies rotate away from broader financials exposure into more focused financials exposure. It's kind of whittling down the strength in that space, as it
Right.
were. We've seen other areas that we haven't seen energy start to come into a lot of areas, but like last year, XLV being the top performer, we didn't see any healthcare come into
Right.
anything,
Yeah.
right? The dispersion wasn't as high, but I think that's interesting to note, right? This kind of helps put the move in perspective. The difference I would say between this year and prior years is that we are seeing rotation on the sector side. We're seeing technology has fallen significantly down in our rankings from the first to the fourth position, even though it's not the worst performing area, it hasn't done great, right? And so we are starting to see some rotation there, and that makes sense with the high dispersion we're seeing in the sectors.
And, to put a cap on what you just said is take this with a grain of salt. You're not going to see the 2 months or 3 months at this point really doesn't mean, it's a quarter in the
Yeah, it
grand
doesn't
scheme
make
of
a
things.
trend.
So if you were to look at this from year by year perspective, things might ultimately change and you might see some broader shifts. But, keep that in mind as you're looking around. Energy's starting obviously to pick up, but when you see these sectors and how well they do, the 2 to 3 month time frame is typically when things kind of run out of steam if it really is just a head fake, right? So
Hmm.
just keep that in mind when you're going through.
Yeah, yeah, absolutely. I mean, what has not been a 2 to 3 month kind of head fake move though is some of the international stuff, right? I mean, that's
Yep.
the other when you take a step back in Dolly, we talked about tech falling in the rankings, energy's improved a little bit. We have industrials kind of doing really well in
Yep.
those. You take a step back and look at it from an asset class perspective. Um, International equities has distanced itself at the top end of those rankings. International equities, domestic equities were tied for a while. They kind of we had a few days where they were moving back and forth, a couple week to week. We're like, oh, is it going to happen?
Yep.
It's happened.
Yep.
It only took them a year of improvement, right? But that's different than a lot of improvement we've seen in international equities as a whole prior. We'd seen like snaps higher, and that led to shoot ups in relative strength that couldn't be sustained. This improvement has been much more consistent,
Right.
and it's taken over that leadership position in the Dolly rankings. And emerging markets have been the big. You had a piece in the report that we've seen a consistency from developed markets, but more recent strength from emerging, probably, right?
Exactly. All of this is ushered forward by the weakness of the US dollar, which we've hit on for, I mean, it seems like the last, year or so. So that's going to continue to be a tailwind for the space. And we're starting to see not only in the rankings, but we're starting to see some pretty monumental shifts in terms of relative strength. Now, when I say monumental, I'm talking about 15, 16 years in the in the making here. What we're throwing up on the screen right now is a relative strength chart, a 6.5% relative strength chart between EEM and SPX or what would that be? SPX? Are we looking at
Yeah,
SPX or
or
is this?
SPX.
Yes, exactly. So point is that we've seen this reverse back down into a column of O's here, meaning that emerging markets has reclaimed near-term strength on this 6.5% scale. Now, what is interesting about this? Well, you've seen, the last time we got a reversal back down off of relative highs was in 1999, right before essentially the lost decade for, domestic equities. Now, I don't want anyone to think that Ian and I are calling that here. But what is probably more likely is if you looked at the next decade, you got continued volatility, continued vowing for control between domestic and international equities. And so I would say that's probably the most likely scenario, at least kind of in that intermediate-ish term. We're going to continue to see strength from both groups and ultimately, where where are domestic equities, where's that relationship kind of heading, I guess.
Yeah.
Sorry for the ramble.
No, no, you're good. And I think I said it wrong. It's SPX versus EEM on a
Yes.
6.5% scale. Just one thing to note. Obviously, for those following along and seeing on YouTube, you'd be able to see that chart there, reversal down into O's. But for those that are not, SPX versus EEM there. Yeah, I mean, I think we haven't seen a ton of improvement, or we've seen a lot of improvement. We haven't seen a ton of column changes. So, I mean, you
Right.
mentioned that it's the exact same number of X's
Yeah, I
in
think
each of
it's
those columns.
26, I think, if I remember
Pretty
correctly.
pretty crazy coincidence there,
Yeah.
but just a coincidence. I wouldn't take anything from that for those looking at it. But like you mentioned, I mean, moving higher, we do typically tend to get more chop when we get turn around the other way,
Yep.
right? It's not when we see improvement from SPX versus EM, it's just straight shot higher. We just
Right.
get that consistent churn higher, domestic equities over emerging markets. Really no ifs, ands, or buts about it. You need a 20% pullback relative difference between them, about almost, to get that reversal down into O's. So when we start to see domestic equities improve, you just don't get that much of a dispersion between it. Just keeps going.
Right.
When we do get emerging markets start to outperform, at least historically, we do get some back and forth movement, right? We do get multiple year trends, a couple of them in there, of ultimate emerging market outperformance, but it does not happen in a straight line. We will have periods within there, multi-month periods, where we see at the S&P, in this case, do better, more than 20% better than emerging markets for stretches of time.
Right.
And I think that's an important thing for people to keep in mind when we're looking at this is that, yeah, it looks like just a three-box reversal, but we're talking about every box is a 6.5% difference. It's almost 20% in order just to change columns. And
Right.
we don't even we get one, two columns in here that are only three boxes.
Exactly.
It's like
Yeah.
these are long-term trends that we're
Right.
looking
And
at.
you're looking, I mean, this is a 40 or a 30-year chart, right? And you're looking at like 20 column changes, right? So these are, like you mentioned, these are long and they're designed to be that way
Right.
for this specific deal. And I'll throw in there, if you were following either strategy, either owning what's on a buy signal, which in this case would still be SPX, or owning what's on a leader from a column perspective, both are profitable, quote, rather than just a buy and hold strategy of either asset on their own. So there certainly is credence to, looking at this and saying, all right, taking this as further confirmation that there might be some longer term tailwinds, at least on a relative perspective on the international front, particularly emerging markets.
Right. And it can also mean too, like we get that back and forth. There will be likely, if this trend is going to continue, there will be other opportunities to come in. Maybe if we get a snap back from domestic and then
Yep.
we don't see international fall out of bed like it has in the past, it's like, oh, you know what, that might be a good long-term buy on pullback kind of
Right.
scenario, right?
Yep.
If this trend is going to persist, there will be other opportunities throughout to jump in. I would be extremely shocked if we get 26 O's in a row. They go all the way
Knock
down.
on wood, Ian.
Knock
Knock
on
on
wood. You
wood.
know what? We'll see. We'll see. Hey, but from there. Well, another thing that's seen a lot of a lot of O's more recently than people might have expected is Nvidia. So why don't we wrap there? I think
Yep.
markets are open by this point, so we should be able to get some data in, right?
Yeah, it looks like we're around
Nvidia's off a couple
about
percent.
3%,
Yeah, two,
which
three
is a
percent.
stark reversal to where we were yesterday after close. It looks like earnings were
And it's our
relative.
first where we were 2 hours ago.
Exactly. Yeah. Well, they looks like when we were, Ian and I looked at each other, like sitting right next to each other. We said we were saved, right? Or Nvidia was up, 3-4% after deal. Then they kind of cooled off to up around 1.5, 2% after hours. We're kind of maintained that number this morning, and now with market open have reversed down lower. This is interesting. I was not planning to talk about them being down 3%.
I wasn't either, and we are 15 minutes into the market for today. We're recording on Thursday, February 26th, so it's around 9:45 right now. When we're looking at this action, though, I mean, if they were up a couple percent, it wouldn't have been honestly that much different on the chart. When you look at the chart of Nvidia, we have just gotten sideways action since really August of last year. And we talked about this, I can't remember if it was last week or 2 weeks ago on the podcast, but even this reversal lower, I mean, we're sitting at a price level at the time of this recording about 189.50. That is barely not even a three-box reversal on the chart.
Right.
Actually, yeah, it is a three-box reversal. One three-box reversal down. We should be right around 190, just above the midpoint on its trading band.
Assuming we don't rally.
Assuming we don't rally, we could go down another few boxes. You got to get down to 180 got to get down to 178 to move back to a sell signal. We've just seen this flip-flopping back and forth
Yep.
throughout the past several months, honestly. So honestly, the support, notable support that I would look at from here, initial support at 180 if we do continue that downtrend. Next support would be that 172 to 170 threshold. If we break lower from there to 168, that would be more of a cause for concern. And then if we break lower, ultimately from 166, it would be a spread triple bottom going all the way back to July and September from last year. But I really think if you get lower than that 170, if you get down to 168, lower than the decline that we saw in November, I mean that's multi-months to kind of go back to get to there. That would be more concerning. If we get down to 180, not a big deal, I don't think. On the upside side of things, there's a couple areas of resistance baked in there too, right? We have resistance right around that 196 level where we interestingly stopped out at yesterday. Then right above that 198 and ultimately at those all-time highs up at the 212.
Yeah, I couldn't have said it better myself. I think this is no, you're good. It's very interesting, right? I mean, like you're just looking at this big range, and I also think this is a microcosm for the general tech space and like just the broader tech space,
Yeah.
right? I mean, you've seen software obviously roll over, so they're not included in this conversation, but you've really just seen not good, but also not bad enough to really be bad. Again, software has been bad, but semis have done all right. Nvidia, is roughly flat for the year now. So, for it to be ranked a three based on our TA score, right, just recently breaking back into a positive trend, for it to be sitting in the middle of this range, it's just kind of like meh. I don't know what else to really say. But that's not a
Yeah, I
layman's
mean
term,
that's why
but
we look at relative strength,
yeah,
right? People that are long-term holders of Nvidia, should you sell it based upon this? Like I would say, if the only stock you're looking at is Nvidia, I wouldn't be overly concerned. It's just consolidated,
right.
right? But there's other things that are doing better,
Yeah,
and I
that's a
think
very good
that's the
point.
important thing to keep in mind here. If this is something a long-term winner, might it have this consolidation period and then explode higher from there based upon something else? Yeah, sure, could
Yep.
definitely happen. Might it have this consolidation period and start continue to consolidate, move sideways, start to move lower a little bit? Yeah, that could happen too, right? I mean, it's been jockeying back and forth between a 2 and a 3 for five for a couple weeks at this point. On the technical attribute rating system, it's in the bottom half of the semiconductor sector matrix. So even if you're looking at other names in the semiconductor space, there's other areas that are doing better,
Right.
which I think is pretty interesting because that was not the case for years.
Right.
But to your point, it's still in the top quartile of the S&P 500 matrix. So
Yeah.
it's yeah, I think meh is a very
Yeah,
very
it's
good
not
way to
like,
describe
what do
it
you,
there.
but I think it's very important. Like you said, you're using relative strength to figure, hey, like, do we want to, are we over allocated? I think this is a very good
Yeah,
opportunity to look at this and say, after the last 2 years, we've had positions in NVIDIA that we just really didn't want to get rid of. I'm not saying get rid of NVIDIA. I'm just saying, are we over allocated? Do we need an excuse to
that
trim?
concentration risk is a real thing.
Exactly. Do we need an excuse to trim a bit of NVIDIA and go find out something a little bit better in the semi space? Or, do we want to play in the industrial space, which has been really strong,
Hmm.
right? So definitely don't get rid of the whole deal. I just think this is an opportunity to say, is there something better that we can go out and be a little bit more active rather than just than kind of looking at this while it consolidates?
Right. And the beautiful thing about relative strength, the beautiful thing about back and forth movement with its consolidation is that it is self-correcting, right?
Yep.
Let's say it consolidated, you bought something else, and all of a sudden NVIDIA can goes off. Yeah, you might mess up some performance there, but you can always rotate back into it,
Yep.
right? That's the thing to keep in mind too. You're not done with it. You don't have to be done with it. So, um, cool. Was there any other charts you wanted to hit on here, Miles?
Well, saying that my computer just died, the answer to that
Uh,
is no. And that's a wrap.
Great. Well, thanks, Miles, for hopping on here. Thanks everyone this week for tuning in. We'll be back next week to touch base on any other action.
Have a good one.